Property, property, property. Now, if you've lived anywhere in Australia, you've probably been blasted throughout your whole life about how we love property as a nation. Whether you live in it, you're renting it, or you're going to be an investor. The Australian dream is to work hard, save up a deposit, buy your home, have it paid off within 30 years, and then live happily ever after. Sounds great, right? And if you're like me, you've heard it everywhere. Your parents have told you about it, your friends, your cousins, those random uncles have told you to invest in property, invest into real estate. It goes up in value all the time. But nobody ever tells you about how difficult it is to manage all of that and how difficult it is to actually get it going to a point where you achieve financial independence, which is the key. Now, I got trapped into this Australian property dream as well. And by the age of 23, I managed to save up $60,000 and purchase my first townhouse. Now, this townhouse was in the Gold Coast. It's next to many of the theme parks that are quite popular out there and had a few projects and infrastructures and things that were coming up that were happening. So I could see growth in the future. And I think it was only slightly negatively geared. But I think when I got into property, the idea was so attractive and it just made sense that you would buy something, even if it was out of pocket for a while, because you do have your tax benefits from there on, that you would just ride the wave out until you've reached your 30-year mark. By that time, you would have accumulated a few more properties. All of them would kind of increase in rent over time, and then you'd be cash flowing and then retired or achieve some kind of early retirement by that 30-year period or prior to that. But then I've run into a couple of walls, right? So my property had tenants in it who damaged the property prior to leaving. Now, that I've never dealt with damaged property, obviously that being my first investment property in my whole life. Obviously there's landlord insurance and whatnot that covered it at the end of it, but I think throughout that whole time, corresponding between my property manager and myself and waiting for the correspondence back from the tenants at the time who'd flown down to Tasmania and who had damaged the walls, the carpets, toilets, all that kind of jazz, was just quite stressful at the time at the age of 23 when I was trying to balance out, my career and whatnot as well, which was, yeah, a bit of a headache to say the least. But you know what, I got through it, came out the other side, had a few sleepless nights and whatnot, but it's okay. And I guess for me, throughout this whole time, I was starting to realize how complicated things could get if I had like a few more properties. If one caused me this much headache to begin with, imagine once I had 6, 7, 8, the typical investor's dream to have 10x properties or 0 to 130 properties or something like that. Steve McKnight's book, I forget how the title goes. And the amount of management that I would have to deal with, keeping up with rates, water. Yeah, the property manager can, deal with all that kind of stuff and do all that kind of stuff, but you can only delegate so much before it comes back to you and you have to give them authorization to go ahead and pay the bills or execute on XYZ, all that kind of stuff. So for me, I started to realize that this whole property investment journey was, even if I had gotten to the end, was passive to a certain extent before I had to actually intervene and then do XYZ. And having not seen money actually come into my pocket for about, a year, 2 years, was also kind of concerning. Like, you pump all this money into the property, you've got to pay, the interest you've got to pay the banks on anything else, then you're negotiating for rates if, the rates go up or down, and then you've got your property manager that you're paying money for, you've got the rates and all this other kind of stuff you're paying for. Unfortunately for me, and stupidly so, I bought a townhouse, so body corporate that I'm paying for, which sucks up most of the money, as many of you who are investors out there would know. And I just wasn't achieving some form of return that I could be happy with whilst I was taking on a lot of stress. And I wasn't even really excited to take on the second, third, the fourth, the fifth property, even though I had saved up enough deposit for the second one and potentially a third one. So that forced me to kind of move over to looking to other avenues of investing, ways that could actually generate cash flows, because for a business or an investor or anybody to survive within the capitalist environment, it's all about cash flow. It's about cash coming in. Like, your brand could suck because, a group of people talk, crap about it. You might receive bad publicity, but if people are constantly buying from your brand, buying from your shop, even if it's a takeaway store, you're still receiving that cash flow. So cash is constantly coming in. That's what I slowly started to realize was what I needed to retire early, which is a whole nother topic because, Anyway, and so from that I moved over to looking at shares. Now, shares for me is kind of I mean, I didn't really think about it. Nobody in my family or my immediate friends or even my extended friends, colleagues knew too much about it. It was all about property in Australia, as I'm sure it is around like different parts of the world. The first blog or page that I started to look at to get into shares was actually the Aussie Firebug. Now, that's a quite popular one, produces great content about retiring early. By the way, FIRE stands for Financial Independence, Retiring Early. That was a big movement over in the US. I guess our Australian equivalent is then the Aussie Firebug. Now, he spoke a lot about the Aussie share market, which I had to kind of learn about the ASX and whatnot, how shares actually work, when I purchase it, who holds on to it, where does money get funneled into once I get my dividends paid, what are dividends, the tax implications. There's a whole multitude of things that I had to learn about within the 3-month period before I actually bought my first share. So within that 3-month period, I addressed many of my initial concerns. One of them first would be to owning something physically. Property, you can buy it, you can physically see it, you can inspect it, you can go into it, look at it and be like, wow, amazing, I got this house now that somebody's gonna rent out and hopefully not thrash. The other thing was volatility within the stock market. Often you see when you do a quick Google search for XYZ stock, for example, CBA in the ASX, you can kind of see it go up and down, up and down, up and down, which is quite scary for some people. And if you look at more of the the tech stocks, the tech stocks, you can see it drastically go up and down within a 1-year period, a couple months period, or mining or any of our big sectors in Australia. They kind of go up and down rather quickly as well. And I think, I can't remember where I read it from, but somebody was saying that if property had, there was like a stock chart equivalent for property, you know, prices would go up and down depending on developments that come on through, news about loan repayments getting too high for buyers to enter the market or to hold on to their property. So, you know, just because there's no stock market in real estate doesn't mean that the prices don't fluctuate either. You just can't physically see it and quantify the amount as easily as you can in stocks. So after all my studying and learning, I then opened a CommSec account. I already banked with Commonwealth Bank, so it was pretty easy to just open the account with CommSec, and then started exploring the page and bought my first stock. Fortunately for me at the time, my partner was using Afterpay. And we were just laying in bed and she had told me about how it actually works, the login system, how you actually just scan a code at the store. I then looked into it myself, had read their initial annual reports. The system is very similar to PayPal in terms of logging in and in making transactions just happen like that. They make a lot of their money off retailers, although there are like a huge percentage in late fees, which they've now reduced drastically. A lot of people will say it's kind of like just like a credit card, a banking system. But I like the way that they would always take the lowest percentage of XYZ fee that was owed, as opposed to taking the larger portion, which most of the credit cards do take out of. And so having read all of that, seeing people use it, I asked many people from the ages of 38-year-old mums all the way down to my brother who was like 16 that knew all about it, and everybody was kind of using it. They seemed fairly ethical for the sector that they're in. And so I bought a few shares in Afterpay. The next day, the price shot up. They announced that they were going into the US and I was like, whoa, this is amazing. I then held on for another day and the prices just kept soaring up. And so I cashed out. A lot of people might say, well, why, you know, a lot of people might freak out because I stupidly put in a lot of money into the company in the first place. But I had been watching a YouTube at the time named Ricky Gutierrez in the US, and he was doing a lot of swing trading. I mean, look, I didn't know too much about swing trading and the benefits and da-da-da. I knew a bit, but now that I've been on the other end of it going down, anyways, another story. And so I made a fair bit of money from Afterpay, went out and was all enthusiastic about the share market and what it could do and what you could do going in and out of it, and have really never looked back. My strategy has moved towards dividends in Australia because they are quite high paying, and that is something that I'm looking to build in form of income in not too far of a future, and there's not to mention the tax implications with that. So currently I'm still holding on to my property at the moment, looking to sell it in a couple years time when hopefully the value goes up by a fair bit. But for me now, I probably look at stocks almost every day. I read the news almost every day. I listen to a ton of podcasts both in America and over in Australia. And I guess the big question is, will I invest into property in the future? Possibly. But I think I might be leaning towards doing duplexes, granny flats, like little properties like that, as opposed to a townhouse with body corporate over it and dealing with, anyways. Cash flow is king. So that's a possibility in the near future. But for me currently right now, I'm looking to build up that stock portfolio that's going to deliver me by the time I'm in my late 30s, a solid income, which I can easily retire off. Probably won't end up retiring. I'll probably do 2 to 3 days a week worth of work, or else I'll just go insanely bored with nothing to do. But anyways, that's it for me. Leave your thoughts below on your experiences property investing. I'm sure there are many property investors out there that'll try to roast me in the comment section and tell me that I've done it wrong, I should have held on, I should have kept going. But the one thing that I've noticed is I've seen people move from property to the stock market, but I very rarely have seen people move from the stock market over to property. That definitely says something. Definitely does say something. All right, guys. Thanks. Bye.